Is it time to get defensive? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Aahan Menon, the founder of Prometheus Research on Substack. Hi, it's great to have you with us.
Hey Maggie, great to be on.
Yeah, your first time, so welcome to the show.
Thank you, thank you. I like I said when we were off camera, I feel like I've been listening to you for a couple of years now at least, so I'm happy to be here.
Yeah, that's great. We're happy to have you. So interesting action today. We had the latest ADP private payroll showed a surprise decline in jobs last month. That, along with some concern about Microsoft sales targets around AI, sort of weighed on sentiment early, and it looked like we were going to see a decline. But stocks bounced back; they rebounded. It seems like they are looking for a reason to go higher. Let's just start really broadly. How are you feeling about U.S. equity markets here?
Um, I would be lying to you if I say I had a completely clear view. I think that, so far this year, we've had an environment where it's been pretty clear that, hey, you just want to buy stuff, close your eyes, and, come back later. But I think as we've kind of progressed through this cycle, you started to see earnings expectations get a little bit heated and potentially frothy, looking a little lopsided, and in the S&P aggregates. And so, we've started to become a little bit more concerned. That being said, I think often concerned can be misconstrued as like go out and short the indexes.
Mm.
And that's not necessarily the view that we have. I think that it's just harder to find value in the indexes lately. And so what we're looking for is really like a bit of a cool off phase. And when we look across markets, we track markets across the globe, global equities, global bonds, global commodities. We track all of that and have signals running for all of them. When we look at that, we do see a good amount of confirmation that, hey, like maybe global economic momentum is slowing a little bit. And that's not to say that it turns into a crash, but it's something to be a little bit more cautious about.
Yeah, that makes sense. And I think that you're giving voice to what a lot of people are struggling with right now, which is there are just a lot of cross currents, right? When you think you've got a handle on something, there's another. And right now, as we're coming to air, President Trump is tweeting about something else. I think it's fuel efficiency, getting rid of fuel efficiency. So you've got that sort of political volatility, infused in, and a lot of it this time around is really directed at the market. So it's making it hard to, I think, kind of get some clarity about the future. It's probably worth, you just mentioned your signals and that you look across all these markets. It's probably worth talking a little bit about, since it's the first time you're on, your focus at Prometheus. And I know you sort of jumped from the hedge fund world to have your own research firm. So what is your approach?
Yeah, so at Prometheus, we have a pretty unique offering. So we do what everyone knows and loves, which is like the classical macro strategist kind of role. We have all of that stuff. What's happening to the growth cycle, leading indicators, liquidity, and CPI forecasting. We do all of that good stuff, just like your favorite macro sell-side strategist. But what's unique about Prometheus is we take that and using proprietary techniques, we systematize that to create rules-based portfolios that span across asset classes globally. We aggregate that into a variety of different strategies, which institutions typically come to us for. So it can be ranging from commodity long short strategies to equity market timing strategies to bond relative value. We basically span the entire gamut. That's our primary offering to institutions. What we're trying to do is we're trying to capture really kind of independent, unique alpha signals within each asset class and aggregate them up to create a comprehensive and hopefully high signal reading of what's happening to the global macro market ecosystem. And then on the retail side, we try to find the most appropriate signals that we can. That, there's a lot in the institutional space that can be done in terms of alpha generation, but it's complicated. It's a full-time job. You have to be in front of screens all the time, trading a lot. We try to say that, okay, we interact with some really, really big hedge funds and pension funds. These guys are doing what's best practice in the industry. What can we adapt? What can we learn and bring to a retail setting that helps, investors do better tactical asset allocation? So that's broad strokes what we do at Prometheus.
That's really interesting. I love the idea of trying to democratize it a little bit. And when I hear you talking about that, I always get sort of a picture of a dashboard, which I think is very helpful, right,
Hmm.
in this environment, especially as we're turning the year. We're all trying to sort of look at what's happening. So let's like sort of knock down some of the big narratives out there, or get your view on them anyway as you're looking at this dashboard. Do you feel so? It sounds like you're a little bit more cautious about equities, but you don't see some sort of big blow up, because there were concerns about the financial system. We definitely know there are some bears out there. We saw some issues in the repo market. Some people were really getting concerned that these debt levels were going to sort of throw us into a financial crisis. Do you see any signs of that based on all of the inputs and signals you're looking at?
So I think the best way I can tackle that is that there are two parts that we can look at. We can look at the growth conditions, and then we can look at the liquidity conditions, which is like the financial plumbing parts, right?
Mm.
And we have aggregate system signals for all of those things. Starting with the growth conditions, I think the growth in itself is not likely to be bad. If we look at what's happening to the business cycle, if we look what's happening to the consumer, if we look at what's happening to investment spending, all of those trends are generally positive.
Mm.
The question is whether they're going to accelerate or not. And given the fact that the expansion has become super lopsided towards AI capex generally, both in the economy and equity markets, it just becomes harder for those growth numbers to accelerate. And that is challenging because the earnings expectations that are baked into the equity market are for acceleration. And so, like, when I say that I'm concerned about what's happening in equities, it's not because growth is going to fall off a cliff and it's going to be really bad. It's just that the pricing's a bit exuberant relative to the path that our models basically indicate. And so it's if you gave me a little bit of price, say you give me a 5-10% down, I would be more constructive on equities. But given where we're currently at, it's where the way we're looking at it across strategies is look for tactical shorts if you're a really fast-moving player. If you're either a real money player or just a tactical asset allocator, maybe you just want to have lower equity beta. That's how we're kind of looking at that growth kind of picture over there. So I don't think that there's anything really bad happening to the economy. There are some pressures in the labor market, and we can kind of talk about that. But I don't think big picture there's anything really bad with the economy like that. On the liquidity side, I actually think that I know that people were really concerned about stuff happening with basically the only real concern is what's happening with SOFR spreads, right? So that those are short-term overnight funding markets, which are very, very relevant to repo. SOFR spreads are not a proven measure yet, right? They've been in place for less than a decade, right? We had the transition from LIBOR, so traders were used to being able to see the old TED spread, right? And the TED spread was goated. It was the best measure you could use to look at financial stress. We don't know that about SOFR, right? And so the thing is that SOFR, and so is the TED, has a huge amount of seasonality. So as we get to basically like there are liquidity funding pressures from like tax issues for banks every single quarter. And as a result, SOFR spreads tend to actually spike towards the end of every quarter. And so we don't have enough data to actually deseasonalize SOFR. So people are worried about SOFR, and I understand. But if you actually zoom out on the visual, you'll realize that it's not that big an issue. And then you can cross-check that with what's happening in other places. You can look at commercial paper spreads. You can look at credit spreads. You can look at the move, all these places. And I mean, you can look at just aggregate repo activity. And when we look at that, that combined measure, it basically says that things are fine. Nothing is breaking in the financial system. And so when I put together the growth and the liquidity picture, I say that, okay, growth's okay, but maybe a little rich. Liquidity is totally fine. Is that terrible for assets? No, but maybe they're just locally a little bit expensive.
That's a great point, because we hear that SOFR issue come up all the time. So that's really interesting to think about maybe the track record of it. So if you were feeling like it's a little bit, valuations are a little bit rich, if people are thinking about lowering exposure to equity, is it obvious what they raise their exposure to? Where does that money rotate out of? It used to be 60/40, right?
Yeah.
Is that changed now? How do you think about it at Prometheus?
So so in our allocations, we look at a range of assets. So we do look at nominal bonds, we look at tips, we look at gold, and we do look at broad commodities as well. Like all of those are viable options. And there's obviously, if none of those are providing like appealing risk-adjusted returns at any point in time, there's always cash, right? But famously, like you don't get paid for owning cash. So I think, when you look at the dynamic today, it's been pretty hard to do the rotate from stocks into bonds, right? Like this year has been a little bit better for that, but not by a lot. I think the trade that's been really obviously working is like, if you rotated any of your gains into gold, which has been just a crusher, right? But when we look at like what are the other viable options, I think the tips are particularly attractive here because real yields are really, really high relative to recent history. They're even in excess of cash rates. The challenge, I think, for nominal bonds is that we're basically in this weird spot where the Fed is stuck between a rock and a hard place. You have inflation, which is just, I don't even know how many months we haven't been at target for now. I think it's been like 5 years of continuously not being at target. But at the same time, we continue to have the labor market deteriorate kind of in a slow fashion downward. And so when you put those two things together, it's really hard for us to get a very meaningful cutting cycle. And that is a real headwind for bonds. And so, should you own bonds when, the term structure of interest rates is relatively inverted and relatively flat? And the risks are that, you could have a reversal in the pricing. It's hard. But when it comes to tips, so the term structure of real yields is a little bit more attractive. So you can possibly consider that as an exposure. Gold is another exposure. And then there's always good old cash.
I think that this is partly what you just touched on, but I have a question. Hi, everybody joining us on YouTube and Substack. We just jumped right into it and didn't get a chance to say hello, including Stamina. We love you too. Thank you so much. But we have a question. What is your take on the flatlined yield curve?
Oh, so basically that yield curves are at zero, basically. I think that, the most basic and like effective thing, just because it's basic doesn't mean it's bad. I think the most basic thing that you want to do when you're looking at bonds is basically to understand that the shape of the yield curve is the single best predictor of returns for bonds over like an intermediate time frame. And so, when you start to piece together your picture of whether I want to own bonds or not, the first thing you want to do is say, hey, like how much curve steepness am I getting? The steeper the curve, the better it is for you. And so when you look at bonds today, you just continually, depending on the tenor, but basically if you look at say 10th threes as your measure, you continue to basically just flirt with negative, slightly positive, negative, slightly positive. And that is basically just what it's telling you is that you can earn maybe a few basis points above cash for a lot of risk. And that's not necessarily the most attractive thing. So when bonds become attractive in this type of environment is when we begin to have a proper recessionary circumstance. And the reason that you need a fully recessionary circumstance is because the shape of the yield curve is carry, right? So when you own the bond, you basically get paid to just own the bond, even if nothing happens. But the only way you really make a lot of money on your bonds in this particular circumstance is if you basically have more cuts than what's priced into the forward curve today. And we're already at 3 or 4. We range around 3 or 4 near constantly. And for you to, make out really well in bonds today, you basically have to have 6 to 8 cuts priced. And that is almost entirely consistent with the recession. And so unless you have a recession expectation, it's pretty hard to own bonds. So, I think the flatness of the term structure is just making US Treasuries hard to own for most people.
Are you keeping an eye on what's happening in Japan? There's been moves in the bond market there, and what's that done? I know there was that concern, right? The yen carry trade is going to reverse. Haven't heard as much about that this time around, but we see when those yields spike that it can sort of send tremors through the global market. What are you thinking there? And is the market too complacent about what's happening, or do you think they're kind of getting the right read on it?
Yeah, so this has actually been one of the largest exposures that we have in our programs. We have short JGBs versus long Italian bonds. So we have long European bonds broadly. But basically, the challenge in Japan is basically that you have one of the hardest economic backdrops they've ever experienced, right? And that is relative to a global aggregate of, looking across the entire world, where global growth conditions are a lot more tepid. And so as a result, I think it's really, really hard for Japanese policymakers to really get their hands around inflation because they haven't had to really deal with it in so long. And it's not like they're having crazy amounts of inflation. It's just way more inflation than they've experienced over the last 20 years. And so I think when you're looking at the Japanese circumstance, you actually have a nominal economy that's actually pretty good versus the rest of the world. Their earnings are doing fine. Nominal activity is doing fine. The Nikkei is up a bunch. And so when you look at Japanese conditions relative to the rest of the world, particularly Europe, it's actually a really, really positive dynamic. And so the best expression that you can have over there is basically to be short JGBs relative to the rest of the world, particularly EU bonds. The place where we actually like the most as a short leg for that trade is actually French bonds, which are called OATs. But broadly, the EU bonds are a good pair to have. That trade has been really, really, I think a lot of people started to notice basically after the BOJ got really hawkish over the last week. But if you actually look at the dynamics that have been unfolding of basically hot end GDP, higher than target inflation, all that stuff, that's been ongoing for a good 6 months, if not longer. And so I think it's just markets are starting to really, really price in those conditions, and people are really starting to take notice.
Is the bond dynamic in Japan a concern for treasuries? Do you see this wave of repatriation happening? It's been the fear. Do you think that will play out, and will that be a problem?
I mean, candidly, I don't have an answer. It's not something that we focus on a lot. What I will say is that there was a time where the repatriation fears were a very significant concern because of the size of the Japanese investor relative to the rest of the world. But as the equity markets have kind of cooled off, as they've kind of gone into their own economic malaise and they've had their own balance sheet recession, I think the spillover effects of Japan are way less than something like the 2007, 2008 kind of period and such. And so I think a lot of people are trying to rerun that playbook of oh no, carry trade unwind, end of the world because of Japan, that type of thing. And now, granted, it's a little bit hard to actually gather data on exactly what the positioning is around this stuff. But at least from the people I talked to, everyone learned their lesson. From doing that carry trade during that time, and nobody's really doing that anymore as much in the buy side, at least from the people that I speak to. And so I think that it's not as big a concern as it's being made out to be.
I'm curious, one of the other risks that people talk about right now, and let us know if you see risks that you think are underappreciated right now based on all the signals that you track. But the other issue has been some of the volatility we've seen in the crypto market. Do you follow that? Is that part of your dashboard, or is that something that you don't participate in?
It's not yet, because I think it's just like a function of, we do business mostly on the institutional side with, larger pensions and hedge funds and stuff like that. And there just isn't the capacity to move as much. And so, I understand, fully cognizant, and people keep telling me every day, when is Prometheus adding crypto? We'll get to it. But, I'm not going to, I'm going to stay in my lane, Maggie.
Yeah. And as many wise people have said, but we certainly know with the volatility, it would probably be something that you'd really have to sort of make sure that you had a handle on. And by the way, when people are not in it often, we have people have very strong views on it, but we also have people say, I can't understand. It's not enough history for me to plug into my framework because I don't really understand what's driving it. And so that's why they stay away from it, which it sounds like is the case when it comes to you. So you mentioned Europe. And I'm curious about that. How are you feeling about the sort of the growth outlook there? And we've seen a lot of political risk, concerns about UK and their budget, concerns about France, and the government changes and their budget. How are you feeling about the euro area as a whole? You mentioned bonds. I don't know if you are tracking equities there, but
Yeah.
there have been so many other hotspots. We really haven't talked about it lately, but it has been a source of concern.
Yeah, I think it's I think the Euro UK dynamic is actually quite interesting. Because most of the euro area is actually quite cyclically exposed. But the UK actually has very, very nice value characteristics in its index. So, when you look across the globe, basically like the best value index you can buy is the UK, right? And the thing that makes it attractive is that, UK, so you do have the whole run it hot vibe happening in the UK, right? But the other side of the run it hot vibe is, I think the starting point of the running hot vibe is it's a very tough time for gilts, right? Like it's a tough time for gilts. But at the same time, what you have to recognize is that nominal growth flows through to equity revenues, right? And particularly if you have a value sort of tilt, if you have a real economy, high dividend paying index, it's highly supportive. Inflation is actually highly supportive. And so what you have in the UK is actually a pretty decent situation and a good opportunity for diversification globally. Because if you look around everywhere else, like, if you look at, say, you look at Germany, which is a highly pro-cyclical industrialized equity market, you look at the US, which is just basically just a tech index now, you have the opportunity in the UK to get something that is actually value, that has these dividend and earnings yields, is putting up good earnings momentum, has positive price trends. And so, a really interesting way to kind of express the trade would actually be to short European equities. So, you can take your pick of the DAX and the CAC, right? And go long the UK indexes. And so that's one of the expressions we've kind of looked at over the last couple of months. It's actually done pretty well. But I think the UK versus Europe dynamic is super interesting because Europe, you have a much more cyclical kind of export-oriented exposure, and that has been having a really tough time. So when you contrast those two things, it actually forms a really nice pair trade that you can prospectively express.
That's so interesting because it seems like, including people who live there in our chat, by the way, feel free if you're watching from the UK who just say it's so depressing and and everyone seems so negative on the UK. That seems such a contrary call that you just made.
Yeah, I think it's just, one of those things that the way my whole worldview kind of works is we have all of these independent signals for all these assets, right? And they kind of all feed up, and I have to make sense of what all of these things are telling me. And so, for the last 2 months, I see 50% of our global equity risk is long UK. I'm like, what on earth is going on there? And I start to back solve, and I start to see, oh yeah, when we look through the earnings conditions relative to the rest of the world, oh yeah, they're not bad at all. It's not US earnings growth, but it's still pretty positive. And so, once you start looking through all those dynamics, you just end up getting sometimes these interesting kind of non-consensus trades.
Yeah, that's so interesting. And Ian, who's chiming in, who is there, said, I'll be avoiding, our country is anti-growth.
More power to him.
Yeah. So interesting. So I want to talk about sort of commodities and silver a little bit, because we've seen these record highs. So when we talk about equities, it feels like valuations are rich for the growth. When you're looking at commodities, what sort of signal are you getting from the commodity market? Because we have seen these record highs. We've seen a lot of momentum there. Commodity markets can behave a little differently. Does it seem to you, based on what you're seeing, that we are on the cusp of some major breakout? Or would you also are there sort of caution signs, signals flashing there as well?
So we actually do the major commodity baskets independently. So maybe I'll touch on each one of them. Right?
Sure.
So starting with energy, energy is basically, particularly from a systematic investor standpoint, but generally also, it's an inventory game, right? You want to understand what's happening to the inventory cycle. If the inventory cycle is moving a lot, you basically, so if inventories are going up a lot, you basically have a downward pressure on price and vice versa. Today, the inventory cycle, there's just not much happening. Why is not much happening? Because, nominal growth has basically slowed down a bunch. And as a result, energy producers all over the world are not doing very well in terms of their profitability. They're not drilling much. That's resulting in not much inventory. So there's kind of like not a lot of signal coming from inventories today. But at the same time, you have geopolitical tensions globally, and they have caused a lot of shipping delays for energy and crude. And as a result, there's more oil on the water today than there was during COVID. And so at some point, you're gonna have all of this stuff hit inventories. So those Department of Energy reports that you get every Wednesday, it's going to hit inventories, and it's going to be a serious downward pressure. And so, I think that when you actually take the inventory data at face value, there's not much happening. Prospectively, there's pressure coming down the pipe. Mm-hmm. And so when that starts to show up in the inventory data, plus we get price confirmation, we're probably looking to press that kind of on the short side on the energy complex. So that's energy. So not, neutral and, potential for a significantly negative event, right? When we look at the industrial commodities, so honestly, the only thing that's really tradable in a large setting is copper. But if you look at the industrial commodities, so like nickel, aluminum, all of these industrial commodities, they basically co-move with the global growth cycle, right? They have pretty strong betas to the global growth cycle. But I think that one thing that really messes a lot of this stuff up is indeed the government shutdown in the US, because the US is such a big player in all of this stuff now. When you don't get all the data, you're not. So we're flying a little bit blind, but we do have some. We have the rest of the globe's data in hand, and what you see there is typically. I think I would characterize the industrial economy globally as one that is recovering out of a contraction. Like, particularly when you look at what's been happening with industrial production globally, there's just not that much activity. And so there are indications that things are getting better, but we just don't have a high degree of certainty that we fully made it out of the global industrial contraction. Now, what usually is really helpful in figuring out whether we're making it out or not is actually to look at industrial metal price trends, because all of the industrial metal price trends are driven by these industrial manufacturing companies. But the thing is that you have so much geopolitical noise, which is mostly just tariff news, just pushing industrial metals all over the place. So on any given day, you have a tariff headline and boom, copper's up 2 or 3, 5% sometimes, and then it's down 10% in one day. And so the price trends are getting super muddled. So if gun to my head, I think that the conditions have improved from a recessionary circumstance, and so they look constructive, the industrial metals. But any announcement can really, really mess up your whole trade over there. So relatively more cautious. Then the last leg of it, there's gold and silver. Honestly, silver, let's say I'm a little bit lazy, and we'll just lump it in with the rest of the industrial metals. We haven't found any like particularly unique drivers just for silver. When it comes to gold, though, I think that what you're seeing today in terms of price action is basically, so a lot of people talked about how the price action can be explained by foreign central banks and this, that, and whatnot. And while that is secularly perhaps true over like say a 3-5 year kind of explanatory variable, when you look at, say a 1 year or less kind of frequency, the driving factor that has explained most of the moves has basically been the ETF tonnage. So what it really is basically, you have a lot of demand for gold today as an alternative investment, particularly given its recent performance. And so what you can do is, you can create composites which basically take into account real rates, silver, tonnage being the primary factor, and say, hey, like, is gold way too far away from fair value? Is it close? When we actually had that blow off top, we got signals that, it was, things were way ahead of what makes sense. And so, we didn't short gold or anything like that. We just got really, really small in our positioning. More recently, we started to add back some gold because, at the end of the day, we think that it's a good long-term strategic kind of asset to own. But with the volatility, with what it's been like, you just don't want to have a lot of exposure. So I know that was a very long monologue, Maggie.
No, it was fantastic. No, and I sort of love the deep look into all of this and the way that you think about it. It's interesting when you're talking about the secular story. You also earlier said it's really hard with bonds, right? So if you're nervous about valuations with U.S. equities, and let's face it, an awful lot of people, as they're looking, and they should, about whether they need to be balanced at this point, the equity portion of the portfolio has probably gotten large over this, bull run. If bonds don't look good, gold has to be part of the answer, doesn't it? I mean, does that kind of create a bid for it in a way that maybe there wasn't before when bonds were the default diversification tool?
I've been trying to figure out a way to put that into a model, like I really have. But I think that a lot of what you're seeing in gold is basically people saying that, man, like bonds have been terrible for 5 years. Like it's just not worked out. And, if you think about it, like the size of institutional asset allocation relative to like the outstanding stock of gold and the total AUM in these gold ETFs is just absolutely massive, right? And so when you have just, even a little bit, say, you have a little bit of rebalance of these big asset managers towards gold, you basically end up getting what we have today. Like there's only so much gold in the world. And so I think that's a very big part of the story.
Yeah, it certainly is. Before we go, do you look at China? Because, that's been the sort of like black hole that no one, in terms of data. So if you're always, needing those sort of inputs to make sure that your models are sound, do you try to factor China in, or do you just stay away from it?
Well, we do look at China. I won't claim to be like a big China expert or anything like that. What we look at is we typically just look at, we do look at their official data. You can do some stuff to try and adjust their official data, but what I'll say is like the rate of change of the official data is probably more telling than the actual data itself, than the levels of the data. So that's one. And then two, the good part is that like, you do have global Chinese equity indexes, and those, while there's a lot of state funding and this, that, and whatnot, like the earnings are actually real, right? And so, you can get company-based measures rather than government, GDP statistics and whatnot. We don't have anyone that's particularly interested in trading, Chinese fixed income local. Like we don't know anyone that really wants to do that. But on the equity side, there are lots of people, and so as a result, like you can, if you're trying to solve for the equity problem, basically what we see is, Chinese economic growth and the way it's translating into earnings is not that good. Chinese economic momentum has begun to slow. We've actually quite recently we started to get much more negative signals from our price-based measures for Chinese equities more generally as well. So I think maybe earlier in the year, it was own as much China as you can. And now it's probably don't do that anymore.
Fantastic stuff. Aahan, this has been such a fantastic conversation. So fun to learn about a little bit about what you do at Prometheus Research. It sounds like it's a lot of good detailed work. So really, really appreciate you coming on and sharing it.
Hey, thanks so much. It was a great time. I really enjoyed myself.
And somebody just said, great show today. Really appreciate the candor. Always. We always want that. But we do appreciate it. So thanks to all of you who rolled up. We will be here with Dale on Friday for his residency. So come with your questions for that. In the meantime, everyone, take care and good luck out there.
Have a good one.